Happy Thursday. It is 4 p.m. in the Eastern time zone, and we believe it is 5 o'clock somewhere. Welcome to Bear Market Brews, brought to you by Hixon Zuercher Capital Management. I am Tony Hixon, your host and moderator of today's show. This is our first edition of Bear Market Brews, and on the call we have Adam Zuercher and Austin Wilson. Excited to have them on board today as we bring you news you can use, where we will break down the latest economic developments related to COVID-19, show you how the markets are responding, and share our latest views on the market. Crack open your favorite beverage, sit back, relax. The markets are closed, but we are open. We're ready to have some fun today. First up, I want to introduce Adam Zuercher. Adam, please tell us who you are, what you do, and most importantly, what are you drinking? Got to unmute.
All right, thanks. Sorry, Tony, you had control of my mute powers. So
Got it.
Can you hear me now?
I can. Yep. Sorry
All right. Good afternoon. Thank you for joining us. We're very excited to launch this new weekly series. I'm Adam Zuercher with Hixon Zuercher Capital Management, Chief Investment Officer and CEO of the firm. This has been a crazy market and uncertain times for sure. So we thought it would be a great idea to launch a new series where we come and speak with you every Thursday and talk to you about our thoughts in regards to the economy, the markets, and COVID-19, of course. We wanted to lighten it up and make it a little fun. So we decided we are going to make it Bear Market Brews, where we have a virtual happy hour. The idea here is that we want to talk to you about things that we would talk to you about if we were sitting at the local pub after hours, just sharing what happened over the past week. We also want to give you a chance to ask us questions. So please ask questions. Go ahead and type your questions in the Q&A if you want them to go directly to us and want to keep those private. If you want to chat publicly, you can type that in the chat. Or if you're on Facebook Live, please go ahead and type your comments on Facebook. Tony will be moderating the call, and he will make sure he directs the questions to us as we go. So again, I'm Adam, and my beer of the week is called Honey Wagon IPA. It's from the Muller Brew Barn in Maria Stein, Ohio. So I had to support my fellow Ohioans as we've been locked down and unable to go out to the restaurants, the breweries. I'm drinking that in my favorite glass from Rheingeist, also from Ohio, down in Cincinnati. And I'm an IPA fan. So while you're at it, go ahead and let us know what you're drinking. Go ahead and put that in the chat. Love to know what you're drinking along with us. And if you're not a beer drinker, that's fine. Whatever it is, we'd love to know what you're having. Austin, go ahead and introduce yourself.
All right. Yeah, I'm Austin Wilson, the research analyst at Hixon Zuercher Capital Management, and so excited to be chatting with you today. This has definitely been some bumpy times in the market, ups and downs lately, but we're excited to bring you our thoughts on kind of what we see going on, but also kind of keep it fun and light. And today, I am drinking a Voodoo Ranger IPA from New Belgium. It's really good stuff. It's a nice IPA, got some good bitter, malty, citrus kind of thing going on here, lots of hops. So pretty excited about it. I am drinking it out of my Brew Fountain glass from Bell Fountain, Ohio, which is down where I'm from. So it's a good time to have a cold beer. Down by Mad River Mountain. That's exactly right.
So Austin, I got to ask, all right, so we're staying home per the governor's orders. You got a microphone, some headphones, some guitars in the background. You kind of look like a DJ. Is that what you do on the side?
It looks that way, but actually I'm a worship leader at our church and love playing music. So all of my guitars in the background keep me occupied. It's a lot of fun. It's a good hobby to have. And yeah, the headphones get used for more than webinars.
Good deal. I love it. Well, a few housekeeping items. Adam mentioned a
Wait,
couple, but
Tony, you can't get away
oh,
without
I'm
telling us what
sorry.
you're
Yeah,
drinking.
watch out. Tony Hixon, partner, client-facing advisor here at Hixon Zuercher Capital Management, drinking a Rheingeist Van Hunks, a Belgian-style golden ale. It's a
Nice.
nice way to close the day. Thanks for asking. I apologize. I forgot that. Few housekeeping
Couple people in
items.
the chat, somebody's drinking a Woodford. We've got a Miller Lite. Columbus Brewing Company.
Ooh,
Also
Columbus is good.
very popular.
Indeed. As Adam is pointing out, use the chat function for everyone. If you want everyone to see what's going on, use the chat function. I'd love to see what you guys are drinking. Might try some next week. The Q&A button, please use that for questions for the hosts. If you type that in the Q&A box, I will be moderating that. If there is time at the end of the call, we hope to get to all questions. If we don't, we'll be back next week to answer more, if not in between times. So we are at a stay-at-home order because of this crazy coronavirus that's going all over the globe. 7.5 billion people on the face of this planet. 2.8 billion are under some sort of stay-at-home order. So, Austin, can you tell us a little bit about the COVID-19 status? How many cases are there, and where are we at with those numbers?
Yeah, well, it seems like these numbers are changing all the time, and we've got some great graphics here to kind of show you what we're seeing. And a lot of these are going to come from Bloomberg. So here on the first slide here, we see that global cases are pretty much at 500,000. Now that has grown substantially, really over the last couple weeks. Really since the virus started spreading quickly outside of China, and the U.S. specifically is around 75,000 cases. That is third by number behind China at 81,000 and Italy at 80,000. Now, I anticipate, based on the rapid rate of growth, both here and to a lesser extent in Italy, that both Italy and the U.S. are going to pass China over this probably next weekend in terms of cases. And the U.S., by the time we're sitting here next week, is going to be the epicenter of the epidemic around the world. Now, when we look at deaths, so this is definitely it's a very deadly virus that we see here. We see that globally, there are over 22,000 deaths reported, and that's around 4.5% of the cases around the world. And in the U.S., we actually just crossed 1,000 deaths here in the U.S. So also not good, but that only represents 1.4% of the cases. Now, these numbers, like I said, are constantly changing. We're seeing big changes every single day. So when we sit down and talk about this next week, it's quite likely that these numbers are going to look a lot different. Next, we do have good news. There are recoveries happening. And for some reason, the U.S. doesn't report this data, but we have good news that there are over 116,000 recoveries, which is 23% of all cases around the world, have fully recovered and are on their way to healthiness again. So that is the good news, and people are recovering from this. It is deadly, and there are people dying, but the good news is that we are in 2020, and we have excellent medical care in many parts of the world. So this is something that we can come back from and heal up from even better than we could have in the past. So when we look at growth rates, we like to see that it's not necessarily accelerating anymore in huge ways around the world. Now, what that is meaning is there are still cases being added all the time, but the percentage change case on a day-over-day basis is less than it was. But here specifically in the U.S., we're still ramping up testing very, very rapidly, and we are seeing an increase of cases of roughly 10,000 cases per day, which is a lot. It was growing at around 25% per day. Now that's slowing a little bit as we test more people. Around the globe, it's decelerating a bit too. But here's a graph to show the global spread of this virus. It started in Wuhan in China, and that's number one in terms of caseload here on this map provided by Bloomberg. Number two, not by much, is Italy there. And number three is the U.S. So the darker the red, the more cases each place has. So you can see that there's a lot of places that have been impacted very drastically, but I would anticipate that that is pretty much going to read 1, 2, and 3 across left to right next time we're talking about this. So it's changing every single day. But there are a couple things that we just admittedly don't know what's going to happen. So we'd like to talk about kind of our thoughts on the medical response or the peak. So Adam, do you have any thoughts on that?
Yeah, I think there's there's a lot of unknowns right now. And you look at, how the virus spread throughout China, and then the anticipation of the spread throughout the US. And Trump has been on record saying, we're going to go for a 15-day basically lockdown. And even though some parts of the country are locked down more than others. And really, I think the big unknown is the health response to the whole coronavirus threat. If we do what we believe we need to do from a health response, that has major implications for the economy. And we're already seeing it. We're going to talk in a little bit about estimated, forecasts for the economy. But I think the unknown is, how long is this going to last, and when will we peak? When will these cases really start to reverse? When will the trend start to be declining? When will we get better news about the spread? Especially, you look at New York has half the cases and growing rapidly. Yesterday, I saw the mayor in LA saying that he believes that LA is about 6 to 12 days behind New York. And his fear is that they're going to peak in about 2 weeks, or begin to peak and really get hit hard. And they already have 90% of their ICU beds full. And so that's the big concern, is Trump has really changed his tone this week. If you go back to last week, he was saying, we all need to really go all in together, and we need to social distance. We need to stay at home, work from home. Now, all of a sudden, he wants to open up the economy again, which we would all love to see the economy open, but we also want to protect the health and welfare of Americans. So if things get really bad in the next week or two, I think there's a big chance that we extend these lockdowns. I mean, just today you had 4 auto manufacturers delay their reopening. They were all going to, they've shut down and they're going to reopen. I think Ford, GM, Chrysler, and Toyota, they were all going to reopen early April, and they've pushed that to mid to late April now. And so if they're shut down, it also makes me believe, like, our schools here in Ohio are shut down through next week. But I think there's a really good chance they're going to extend that. So the longer things get extended and the longer this pandemic drags on, the more uncertain the economic output or economic, impact will be. Yeah. So you have some saying we're just a couple weeks out from beginning to get back to normal, and you have others saying it could be 6 to 12 weeks out. And then there's concerns about, what about a second wave? What happens when we get back to normal and then there's kind of a second wave of infections? So the good news is China's a bit ahead of us there, and we can kind of see what happens there. And I'm really hoping that, all of the people in the healthcare sector will continue to work hard and come up with some therapies and things like that to really mitigate the spread.
Yeah, and I think too, Austin, we were reading some research on maybe warmer climates. What impact does warmer climates have on this virus, is the theory?
Yeah, it does. So if you think other sicknesses and viruses typically slow down a little bit when the weather gets warmer. Now, it's not necessarily known at 100% certainty with this virus specifically, because we've only had it around for a short period of time. But many experts really anticipate that, as it's not necessarily how the virus reacts, but as people can be outside more, that's often going to allow the person-to-person interaction to be a little bit further apart. They're not all going to be sitting up shoulder to shoulder in a restaurant or whatever. They might be outside. So that could help things in the summer. But like Adam just kind of referred to, the risk that a lot of health officials are talking about right now is that we see that when maybe things cool down again, the virus is still out there, and people are going to be back inside, back touching each other, back kind of around, close mingling back when it's colder, and that could have a second wave and kind of flare back up again. Now, hopefully the medical system has kind of developed a bit more treatment and maybe vaccines by that point, but we're not there yet.
Yeah, for sure. For sure. So yeah, attendees, we're in the middle of bear market brews. The definition of a bear market is 20% decline from the last peak. We're definitely there, but we had a shot in the arm last night. The Senate passed economic stimulus bill. Government intervened into this crisis and shot $2 trillion of money into the economy. Austin, tell us a couple things that bill included.
True, yeah. So last night we got from the Senate, the vote passed on the fiscal stimulus bill that totaled, wait for it, $2.2 trillion with a T.
Whoa,
$2.2 trillion. That's a lot of money. So
how are we going to pay that back?
Don't ask that question. People do not like being asked that question in Washington.
Gotcha. Don't put that in the Q&A. Nope.
Yeah, exactly. So $2.2 trillion fiscal stimulus plan. Now, there's two ways the government is intervening. And first, we'll talk about fiscal. There's also monetary. So $2.2 trillion of fiscal stimulus, which is the government spending to kind of support the economy. This includes a number of different things. It includes $500 billion to back loans and aid companies. And it's notable that the Democrats pushed very hard to get the president's businesses and that kind of thing excluded from this aid. There's also severe restrictions on buybacks and dividends for any public company that takes this aid. And there's going to be oversight to make sure that executives don't benefit too much from this particular part of the package. So that's a big chunk of it. Another sizable chunk is $350 billion in small business aid, which is really loans. So I put that in air quotes. It's loans that will really be forgiven if businesses don't lay off workers. So it's pretty much a grant more than a loan. There's also $150 billion for hospitals and other healthcare providers, another $150 billion for direct state aid, and then the biggest chunk of it, or half of it, is $1 trillion for individuals. So this will either be delivered directly by electronic funds transfer to your bank account or by check. Secretary of Treasury Mnuchin expects most of it to be electronic within 3 weeks, and those total $1,200 per adult and $500 per child for individuals with 2018, if that's the latest the government has, or 2019, gross income less than $75K for individuals, or $120K, I believe, if you're filing as head of household, or $150K if you're married filing jointly. So above those thresholds, the money tapers off.
So I'm going to get $1,200 in my bank account, but my governor is telling me to stay at home. What am I going to do with that money?
Well, that is the question. So a lot of what the stock market has done the last handful of days is anticipating that you're going to go out and spend that money and kind of prop up the economy. But the truth of the matter is that money is probably going to be used on needs more than once. So you're going to be spending on things you already would be spending it on anyway. So there's really no growth. This is like I kind of view this as a limp buy mode. Like, we're not really stimulating the economy. We're just getting it by until this virus is passed. So yeah, I think it's very interesting. There's a lot of different levels through this. There's a couple other provisions are that tax day is now pushed back about 3 months into the middle of July now. And unemployment benefits have now been expanded, and they're quicker. They were 26 weeks at whatever the percentage is of pay, and now it's 39. So that is one side of things, fiscal stimulus. The other side of it is monetary. So when you think of monetary, we think of the Federal Reserve and the actions that they take. Well, we've already gotten 2 emergency Federal Reserve rate cuts. Now, these rate cuts have been the first emergency cuts since the financial crisis. And you see this here, those 2 green circles on the right there. This is Federal Reserve Chair Jerome Powell. He really was pushing for this to kind of put some sort of floor to say, let's stimulate some spending, some investment as much as we can. Let's make borrowing costs as low as possible. So what this does is this makes short-term interest rates, so really overnight rates to banks from the Federal Reserve, really, really, really cheap, which will then flow through to other different lending to businesses and to individuals from there, to try and salvage whatever economic activity we can while things are already drastically slowed down. So in theory, this is a really good time to think about things like refinancing mortgages or whatever, because these short-term rates are going to flow through to longer-term rates and make things for borrowing really cheap. But that's one half of the monetary policy. The other half of monetary policy is really quantitative easing. Now, quantitative easing is a term that really came to light during the financial crisis in 2008 and 2009. And what this really is the Federal Reserve purchasing fixed income assets out in the market. Because what the problem is right now is that in fixed income, people are just selling. There's not enough buying going on because people are scared and want to go to cash. And there's a lack of liquidity is the thing there. So that people cannot meet buyers and sellers together. The markets don't. And this is causing really an issue in fixed income that's not typically there, because typically fixed income kind of works in opposite direction of equity markets, and they've both kind of gone down together lately. So the Federal Reserve has really stepped in with a blank check. And this is kind of unprecedented because usually the Federal Reserve can step in and say, over X amount of time, I'm going to spend X amount of money in buying these certain types of fixed income assets. Well, now they said, we're going to buy a ton of different kinds of fixed income assets, and we're not going to tell you when we're going to stop or how much we're going to spend. And this has really put a little bit of a floor into the fixed income side of things and is going to help stimulate that side of things. So between the two areas of government intervention, monetary policy and fiscal policy, the total is around $6 trillion of stimulus into the economy.
Trillion with a T, right?
$6 trillion, and that is around 30% of our GDP as a country, and that is huge.
Wow. That is huge.
What this does is it really brings to light the fact that we have an issue looking at huge numbers like this. Like when you put huge numbers like this, we don't understand what a trillion is. Trillions are enormous amounts of money, but when we hear certain people or certain ideas of policies and how much this will cost, everyone asks how you're going to pay for it. Well, we seemingly came up with $6 trillion in a couple weeks because of this. So that really puts a lot of options on the table going forward.
To all the grandkids represented on the call, we apologize. So, Austin, let's get Adam's perspective here. We're looking at this chart where rates are zero. Is there speculation as to how long these zero interest rates or these low interest rates will last?
Well, if you just look at the chart and go back to 2008, and we lowered rates to zero back then, and I would say back then we never expected rates to be this low for this long. And so I think the theme is lower for longer. And the crazy part is there's even parts of the world where they basically have negative rates, which is kind of hard to imagine that the US would go to a negative interest rate policy. And the Fed has said they do not want to do that. But I believe low rates are here to stay for a while. There's really two things the Fed looks at when it comes to interest rate policy, and that is inflation and unemployment. And so we've had a great job market until this week, which you're going to talk about in a minute. Record number of jobless claims last week, but the unemployment rate prior to this whole crisis was as low as it's been in 50 years. You have to go back to 1969 to get a 3.5% unemployment rate, which is where we were prior to the whole coronavirus crisis. Yeah. And then as far as inflation goes, everyone thought the conventional wisdom was all the QE, all the stimulus that the Fed did in 2008, 2009, and the free flow of money would just create rapid inflation. You saw all kinds of videos on the internet about all these people saying you want to own gold because there's going to be rapid inflation. Well, it never happened. And what the Fed is looking for is they actually want to look at, they do want some inflation. They want inflation of about 2% is a good number. So if it gets ahead of that into the threes, they're going to start raising rates. If it's below that, they're going to keep rates low. And so I certainly don't see high inflation anytime soon. I think everything the Fed has done is really just to keep financial markets stable and moving and liquid. And so I think we can all enjoy lower rates for longer.
And to add to that, I think that the Federal Reserve sets that 2%, kind of bogey for inflation, and we've run under it for a substantial amount of time. So running under that Powell has really said that he seems to be okay with running a little hot for a while. So if we were even to see inflation pick up to above 2%, they might be okay with that without raising rates, at least for a little while. So I think that's something to consider. A great question from the chat that I wanted to touch on is, do we anticipate additional stimulus packages throughout the year? Mm-hmm. So I think that on one hand, the monetary side of things with the Federal Reserve is pretty open-ended. So I don't really see a change from that side of things. They're just going to keep doing whatever is necessary to maintain liquidity in the fixed income markets. But on the fiscal stimulus side of things, yeah, it's very, very possible that this trickles out longer than lawmakers have really planned for, and that we will have another package and need another package here before too long. And many experts are actually considering, putting a number on that, about another $2 trillion. And that could be in a month or two after that. So yeah, we'll just have to kind of wait and see the impact of this as we know more. But the likelihood that we will have another fiscal stimulus package is quite high at this point.
Cool. Yeah. So Austin, you mentioned the payments to the people, right? $1,200 for individuals, $500 per child. We have a question coming in. Will that money that they're sending us be taxable? I would definitely recommend talking to your CPA, but from the research that we've seen and that we've done, the answer is tentatively no, it will not be taxable. However, as the bill is analysis of the bill is done, we'll have a better answer firmed up for you. But it would seem pretty crazy if the government would give us a bunch of money and then tax it. So our preliminary research would show that those payments will not be taxable. All right.
I totally agree. I think
the whole bill is, I think 800 and some pages long, and which is actually down from one of the versions that they had. But our financial planning team is in the process of dissecting that, researching that. We will have a meeting tomorrow. We're all going to go through that. So answers like that, we're going to have way more detail on all the details in the bill. And so if you have questions and you're not sure who to ask, feel free to reach out to us. We do have an email set up. It's BMB for Bear Market Brews at hccapital.com. And if you didn't get a clear answer on the call, you can always email that and we'll follow up with a better answer.
It's true. All right. So we talked about the status of the COVID-19, some good numbers there. The government intervened. Let's talk about some macroeconomic indicators. So jobless claims came in this morning. They were a blowout in a bad direction, right? Yeah. So the top number in history was 650,000. This one came in at 3.2 million.
That's a big number.
So the expectation was 1.7. So we doubled that, and we quintupled the previous record. So Austin, what kind of macroeconomic indicators are we tracking, and what are our thoughts on those?
Yeah, I think you hit the nail on the head. I think jobless claims is definitely a big one. I think that this is kind of an early indication of some of the macroeconomic impact this virus will have on our economy. So yeah, this is a long-term chart looking at jobless week over week initial jobless claims. So this is like new jobless claims from this week. And you can see that's 5 times the previous record. And that previous record was actually during the financial crisis at about 650,000. And the unemployment at that time rose to 10%. Now, many experts are actually thinking at this point that around 10 million Americans are going to need some sort of unemployment benefits during this time. That's a big number. And these are numbers we really haven't seen before. But what's driving this is the fact that many whole industries, not only in one area, but around the country, are being shut down and impacted by that. And a lot of people are not working, and that is causing them to file these unemployment benefits. So that's something we're definitely watching. There's a next chart I'd like to show you here. Let's pull that next one up. So this compares the S&P 500, which is a very good indicator of the overall U.S. stock market, to jobless claims over time. And we can see there's kind of an inverse relationship going on. So if we look around 2008 and 2009, jobless claims peaked when the S&P 500, kind of hit its bottom there during the financial crisis. And what we see on the right is what we've seen today. We saw this huge drawdown in the S&P 500 since its all-time high. And at one point, it was down over 30%. And now we've seen this huge spike in initial jobless claims. So actually, we look at it a different way in the next slide. If we look at it and then we invert initial jobless claims. So it's actually the opposite. It's 1 over the initial jobless claims figure. We can see that when you look at jobless claims and the S&P 500 together in this way, they run a very, very close relationship, and we've had a huge drop in jobless claims recently. So that's a very tough comparison to look at when you see we've had a record number of jobless claims, and the stock market's down, but it's not down to the extent that the jobless claims are. So interesting times we're in right now, and that's one thing we're looking at right now. Another is the fact that these are ones I don't think I have charts for, but PMI, when we're looking at indicators for growth versus contraction in
What's
different
PMI,
areas.
Austin? What's that
So
stand for?
that is a manufacturing index, purchasing manufacturing index. There's 2 providers that provide that, Market and ISM. We use both, but these are very high-level discussions, not necessarily talking at numbers. But we've seen them over 50. 50 is kind of a bogey for expansion. If they're over 50, these areas have been expanding in the economy, and we've seen those over 50 for a long time. And even recently, manufacturing was over 50 after a period where it was under. Well, we anticipate both areas of the economy being sharply impacted by this and really signaling economic contraction for the first time in a long time in total. So that's a negative for us. Also, when we talk about GDP, so gross domestic product, kind of the sum of all of the goods and services that change hands and transact around the country and the economy as a whole, JP Morgan believes that annualized GDP will contract 10% in the first quarter. And note that the first quarter is only going to have 1 month where this virus is actually having an impact, and that's March, because the first 2 months were relatively unscathed, and 25% more contraction in Q2. Bank of America, on the other hand, says 12% in Q2 with no full recovery until the middle of 2021. So what we're seeing is what sounds like an almost sure bet at an actual recession. So a recession by definition is two quarters consecutive of negative GDP growth. And that sounds like something that we're going to be experiencing right now. So that's something that we're concerned about, obviously, but also watching very, very closely. And another high-level point that I would like to make is that earnings estimates are constantly being revised down in this time because the data is changing all the time. But this makes it very, very difficult to determine a valuation for the market, because it's easy for someone to look at the market and say, based on what you're paying as far as price for a company versus what it's earning, here's the fair value, and here's historically what it's been. Well, when those numbers are changing so much, so A, the price has come down drastically, but B, the earnings are moving estimates all the time. We don't really know the full impact of that. It's really hard to put a fair value gauge on the market as a whole. So it's really caused some challenges when we're trying to plan what a company's worth, what the market should be doing right now. And these are just a handful of the factors that we're watching going forward.
Makes sense.
Yeah.
Makes sense. Appreciate that. Adam, were you going to say something?
Well, yeah, I threw in this chart here. Austin mentioned that JP Morgan came out recently with a 25% negative GDP in Q2. Prior to that, Goldman Sachs had a negative 24% drawdown. And so we looked at quarterly GDP going back to 1950, and you can see that all the red are the negative quarters, and they're extremely uncommon. In the 291 quarters that we've had since 1950, the U.S. economy has only contracted in 41 of those quarters, or only 14% of the time. Furthermore, 5% declines are incredibly rare. There's only been 6 prior quarters where GDP has declined by 5% or more, and never have we had a decline as large as they're forecasting for this quarter. So that's a bit alarming, but we've also never had the kind of government intervention that we've had with this round. So that's good that will offset quite a bit. Keep in mind that 70% of GDP is comprised of consumer spending. So the fact that the consumer is really pulling back, the government has to step in order to keep the economy going. And so, we joke around that it's not really an economic stimulus plan, but it's an economic stabilization plan. They're really helping us get through the next couple months.
Yep. So
I
they're
have a
stepping in with that $1,200, hoping that we'll get that out into the consumer, right? Consumer
Exactly.
spending.
So I wanted to comment on two areas of the economy. One is the food. So when, I think it was the 15th, Sunday the 15th, Governor DeWine announced that by Monday night, the 16th, bars and restaurants needed to close, and they were only to be open for takeout. So we're here in Ohio. We were one of the first ones to do that. Take a look at this chart. It shows you how over time Americans have been eating out more. So the blue line is the percentage of total retail sales that is spent in bars and restaurants. The red line is the percentage of total retail sales that is spent at stores to buy food. And as you can see, people are eating out more than ever before, and they're doing less and less of their own grocery shopping. So, this whole shutdown is a big hit to the food service industry. The nice thing is they do have takeout open, and, support your local restaurants because they definitely need it right now. So I would encourage that, but it's just an idea here the idea here is to show you how much our economy has changed just in the last 20 years, where eating out went from 9% of sales to now 13% of sales.
Wow. Yeah. It's an interesting chart. So, okay, retail sales, bricks versus clicks. What do we have here?
So this is the second piece of the economy that I wanted to highlight. And it actually is a bit encouraging because what it's showing you is that if you look at bricks and mortar stores, that's the blue line. This is the percentage of total retail sales that they have, which is 11%. And then non-bricks and mortar stores, so basically online stores, you can see online sales have been skyrocketing from 4% of sales in 92 to now 13% of sales. So that in a way is good for a lot of companies now that we're at home. And, it's amazing where we're at today with the power of the internet and online services. We can function. And that's the nice thing is we can function in a stay-at-home, work-at-home environment. If we couldn't, boy, that would be even a bigger hit to the economy, wouldn't it?
For sure. Well, hopefully all the participants, callers in, thank you again for your time. You're enjoying your brew or favorite beverage. If you need to refresh, feel free to do so. So Adam, Austin, we've been gathering every morning, around the clock since this crisis really began. And there are a few slides, a few indicators that we've been looking at on a daily basis. Adam, can you kind of give us an overview of this bear market and what are the indicators that we're looking for here?
Yeah, sure. So first off, let's talk about what a bear market is. Yeah. So the definition of a bear market is a 20% or more decline in stock prices from the all-time high. And this is the first bear market we've had since 2009. Now, we've had a couple of really close occurrences. In 2011, we were down 19% when Standard & Poor's downgraded the U.S. debt rating. And then in the fourth quarter of 2018, we had a decline and we were down 19%. And I think it was 19.78. So if you round up, it may have been 20. Some people actually call it a bear market. But we recovered so quickly that it didn't feel like a bear market. So now we're officially in a bear market. We're down actually now. Well, this is through last Friday. We were down 31.8% last Friday on the Standard & Poor's 500. And what I wanted to do was show you the history of major drawdowns. So this is going back to 1928. And you can see that this is one of the largest drawdowns we've had, but not nearly as bad as the one from 2008. The financial crisis was a 56.8% drawdown. And then the drawdown after the dot-com or the tech bubble burst, and then we had the September 11th terrorist attacks prolonging the recession. We had about a 50% drawdown there as well. We had another 48% drawdown in the 70s, and then the Great Depression, an 86% drawdown. So as you can see, just in the past 20 years, we've had 3 very big drawdowns, but we've also had some very big bull markets as well in that period. So overall, it still has been a good environment for investors. But I wanted to give you some perspective on bear markets today. So we're going to look at a couple of slides just to educate you on what happens in bear markets. And I guess the main message I want to send is when you look at this chart, large drawdowns are normal. These have happened throughout history. We have had drawdowns like this and even much worse than this. And every time we've went on to record a new high. This is the 13th bear market since World War II. Bear market meaning 20% or more. The average bear market does have a 30% drawdown, and we do end up recovering from that, going on to new highs. Because you have to remember what the stock market is all about. The stock market is just a way to invest in businesses. And all of these businesses are publicly traded, and you get an ownership in that business. That business, that stock will do well over time if the business is profitable, they have earnings, and earnings are growing. So what do we know about bear markets? Well, bear markets are just an adjustment in what the market thinks that business is worth. But the true economic value is based on the fundamentals of that business. And many businesses are durable enough to survive recessions. And so that's what we're focused on as we manage money for clients, is identifying the businesses that are going to weather these types of environments. Let's look at this slide. So what we looked at here was every occurrence where we had a 30% drawdown or more from a record high. And the big questions that we want to answer are, how long does it take the market to reach the final bottom? And then how long does it take for the S&P 500 to rally back to new highs, basically to get back to where we were or achieve that, high water mark? So there have been, here we are, this one, but there have been 6 prior periods where the market has had a 30% or more decline. And what you can see here, and these are the dates of the declines, the average it has taken for the market to reach bottom is 1.7 years. The median is 1.6. So what that tells me is bear markets are longer than we think. Here we are, we're not even a month. We're a month and 7 days into this bear market. The question is, have we hit bottom? The S&P 500 and the Dow have rallied the last 3 days. Is this the bottom? That's the question that we want to look at today. Nobody knows for sure, but I'm going to give you our educated guess. So the shortest drawdown was just a third of a year. Now the question is, after you hit bottom, how long does it take to get back to where you were before you went down? And the answer is, on average, it takes 8 years. Wow, 8 years? Now that is very skewed by the Great Depression. So if we take that out, you can see it's not that long. It's more like 3-4 years. I think it's 40 months is the answer.
Mm-hmm.
Okay. So keep that in mind, is that bear markets take time to go through a bottoming process. And I want to show you just the last 2 that we've had. So on the left, you see the bear market from 2000 to 2007. The red in each of these charts shows you that initial 30% drawdown. As you can see, we had that 30% drawdown. We went a little further and we rebounded. But that was a head fake. And then we contracted more. We ultimately hit bottom on March 9th, 2009. And it took us, I'm in the wrong one here. Back in 2000 to 2007, we bottomed in 2002. And it took us until 2007 to get back to where we were. Now, look at the last one from 2007 to the bottom in 2009. This is the one where we dropped 30%, and then further, we had a couple of rallies, but then ultimately bottomed in March of 2009. And it took until 2012 to get back to where we were in 2007. So that was a 5-year process of getting back to new highs. So I want to show you a couple of indicators. So nobody knows how long it's going to take to hit bottom and get back to new highs. There's a lot of theories out there. And one of the theories this time around is the economy was humming along very nicely. And the market is kind of like a rubber band. You pull back, we have contraction or a big drawdown, but the faster we draw down and the farther we draw down, the faster we'll snap back, which could happen. But there's a few indicators we're watching to, get some clarity on that. One of them is the VIX. The VIX is what is also known as the fear gauge. So it's the volatility index. The higher the VIX, the more fearful people are. You can see we hit an all-time high on the VIX just 10 days ago, March 16th, 82. We've not hit a level that high since 2008. And you can see when the VIX is spiking, down here we have the S&P 500. That's every time the S&P 500 is falling. Here, this is something, it's a closer chart. It's a year-to-date chart of the VIX. Currently, the VIX is at 60. Couple signs we're looking for. We want to see the VIX go lower than 60, and we also want to see it trade less than its 20-day moving average. That tells us that things are calming down. So that's one of the indicators we're watching. We're not there yet. So we think, we're not out of the woods quite yet. Here's an interesting thing. Every bear market has had a bear market rally. So right now we've had 3 up days in the market. And we've had a nice run. We're up 15% or more off of the low that we've had so far. But keep in mind that every bear market in the past, look at 2008, we had a 23% bear market rally, and then we went lower before we hit the ultimate bottom in 2009. This shows it in perspective. So here we are in 2020. This chart is through last night. So we were down about 34% on the S&P 500, and we've rallied 11%. So where do we go from here? Well, I think it's helpful to look at some prior environments. Let's look at 1987. In 1987, we had a drop of 33%. We rebounded 15%, but then we retested the low with another 13% decline before ultimately moving on. Same thing in 1929. We had a 18% rally, then another 27% decline. So this is what we call a W-shaped recovery. There's talk about a V-shaped recovery where we come down and then bounce right back up. I think that's what we all want, but the reality is we think that this environment is more like a U-shaped or W-shaped. It's looking like a W-shaped where we go up a little bit and then we come back down lower before we ultimately bottom. Now we've had some really big up days. Keep in mind, these charts are just showing you that many of the biggest up days happened during the 2008, 2009. So the largest up days do happen in bear markets. So we can get very excited about the activity the last 3 days, but keep in mind that the worst days are often followed by the best days, and we're just in a high volatility environment. So we're not calling a bottom yet. The price will have to tell us eventually. This chart shows you some of the best days for stocks. So these are the best days for the Dow, 10% gains or more in one day. So we had one of those on Tuesday, up 11%. The question is, where's the market after those best days? Well, on average, a month later, it's down 3%. 3 months later, it's down 4.5%. And 6 months later, it's down 8%. And 12 months later, it's down 3%. Just another sign that we may not be out of the woods yet. And this chart, this shows you the long-term trend line. If you look at the trend line, you can draw off of all the lows we've had since 2009, every correction we've had. And we've now violated that trend line. So it's going to be very interesting to see what happens in the next couple of days, because that line is going to act as resistance. If we can break out of it, then yes, we may have hit bottom, but it also may hit, it may be the ceiling where we retest the lows. I'm going to go ahead and skip that slide in the interest of moving on and let you know. I know we're getting short on time. So this is one other very short-term indicator to look at. We like to look at moving averages and see where is the price trading in relation to moving averages. Right now, the S&P 500 is trading around 2,600. That's the white line. We like to look at the 8-day moving average, the 21-day, the 50, and the 200. And that's just averaging those number of days or prices. What you want to see on a chart like this is what we had right here before we started the bottom, where the price is above all the moving averages. The short-term moving averages are above the long-term, and those moving averages are rising. We've seen a decline in the moving averages. The 200-day is really the long-term trend, and you can see that sloping down. All of these are negative, but we're seeing possible reversal here as the price finally went above the 8-day moving average. We'll be watching this closely. So tune in next week to see where we are with these moving averages, because these will be the signs we're looking at for a change in trend.
I think those are really great charts and some great insight. Thank you for that, Adam. I think clients and people on the call are really wanting to know, well, what should I be doing in this market? I'm almost frozen with fear. I'm not sure what to do. What kind of advice would you offer to clients in this type of market environment?
Biggest thing is don't stop investing. Don't stop your monthly, I hope you're dollar cost averaging, you're investing in your retirement plans, your 401k, putting money away for your kids' college. Don't stop doing that. In fact, add extra if you can. Make sure that you're doing your homework. You have the right strategy for your plans. Work with an advisor if you can. Another couple of things really quick. The new stimulus package also waived required minimum distributions. So if you're above that 70 and a half or 72 age, you don't have to take those this year. That's good news if you don't need it. Look at refinancing your mortgage if you haven't already. Record low interest rates on mortgages. Mm-hmm. Now's the time to also consider Roth conversions with the market being down. And then one last thing for anyone who maybe is in a cash flow crunch, this new stimulus package also provided a provision where you can pull money out of retirement plans with no 10% penalty, up to $100,000. And you can even spread that income. You will pay tax on the income over the next 3 years if you want. But the good news is no 10% penalty. So there's a few things you can do to take advantage of this environment.
Cool. Yeah. Thank you for that. All right. Well, we are getting near the end of our time together. Before we go, we want to make sure that we answer any questions. Again, use the Q&A box, type in your question, and we will try to answer it before we end the call here. However, before we do that, as you type those in, I want to let you know, if you're like many investors, this market has you unsure of the next move. It's our belief that most investors do better when they have an advisor. If you don't have an advisor, you should. A good financial advisor is there to coach you through times just like this. I invite you to go to hzcapital.com/start and go through our 6-step process, and which you can also click here to schedule a call with us to see if you'd be a good fit for our wealth management firm. All right, I'm looking at the Q&A. I'm seeing a couple come through. Austin, I want to start with you. The S&P 500 is an average. Some companies do well, some companies don't. What companies or types of companies will thrive in this COVID-19 crisis?
Yeah, that's actually a really, really good question. So I think that, first of all, in really volatile times like this, focusing on durable companies is going to be key. So companies that can really perform well and have positive earnings and grow their business, or at least maintain their business in times when the economy may not be growing so quickly. So we would, say things like consumer staples are going to be huge in this time. So I'm not, to name a few names that are in that category, not saying these are great investments, but
Sure.
To say a few names, things like Costco or Kroger, or places that you're going to go to get the things you need to survive, those are going to continue to get a lot of business during this time. I also feel like, specifically in the environment we're in, considering that this is a virus that's causing a lot of issues, healthcare companies are going to be doing pretty well. There's companies that are working on treatments or vaccines for COVID-19. Those could be doing pretty well. There are also just companies that are in the healthcare sector, whether that be insurance or other medical supplies. So those are going to be areas that we would be particularly bullish about, as well as maybe things like e-commerce, like Adam said, a lot of us are working from home. We're staying home a lot, especially in Ohio, as it's kind of mandated. We're probably ordering things on Amazon, and not saying Amazon is the best fit for everyone, but that is an example of a company with an e-commerce business platform that is going to probably do okay in times like this. So those are some areas that I would say are going to do decently in an area where we were just uncertain about the full extent of the recession and everything that's coming on here.
Great. Good. Thanks, Austin. Adam, in your comments, you had mentioned that there are no RMDs in 2020 based on the new stimulus package. Are you serious? Is that really part of the bill?
It is. Yeah, they waived RMDs because your 2020 required minimum distribution is based on the 12/31/19 market value of your IRA. Okay, so that's when the market was near all-time highs. And you have the whole year to do that. But if you haven't taken your RMD yet, if you needed to, and we were, prior to hearing this news, we were, recommending clients defer it until the end of the year, hoping for a recovery before then. But that is waived for this year, and it avoids clients having to sell stocks while they're down in value. Mm-hmm. So this is a huge provision that I think was a good part of the bill.
Indeed, for sure. And as part of the act that was signed back in December, not only do they don't have to take RMD, and the age limit for contributing to a traditional IRA was waived as well. So they're also able to contribute and get a tax deduction that way also. So we are nearing the end of our time together. Austin, Adam, thank you so much for your time and your insights into this week's call. Thank you for all of our attendees as well. We certainly appreciate your time. Remember, as long as we're in the bear market, we will continue to host these weekly calls, virtual happy hour, 4 p.m. on Thursdays. Crack open your favorite beverage, your favorite brew, whatever it might be. We are so thankful for your time. If you have any questions in between times, we do invite you to email us at BMB, Bear Market Brews, BMB at hzcapital.com. We had a lot of attendees on the call. We love having you on the call. Share us with your friends, social media, email the link to others. We want to provide value to as many people as we can. So please share us with your friends and colleagues. Until we're done with the stay-at-home order, virtual happy hour will be the best hour of your week. Even though we are in the midst of a bear market, we are convinced that no matter what is happening, the best is always ahead. Thank you again for your time, and we'll see you all next week. Take care. Bye-bye.
Thank you.
Thanks.